For more, let's bring Catherine Avery, CEO and President of Catherine Avery Investment Management. Catherine, thank you for joining us. What really stood out for me from Gina Raimono's visit was this line and her warning to her Chinese counterparts that China was becoming uninvestable in the eyes of some US executives. I wonder how you think about the geopolitics and the risks around China as you position in the months and years ahead.
Well, I think on the head, the real question for us and what it really means to the U.S. equity markets is China's ability to get back on its feet economically. As you mentioned before, it looks like we're seeing some good improvements in the Chinese housing market, and that's good, I think, on all fronts for us here in the U.S. because China doing much better gives us much more confidence here. And that China has a lot of exposure, a lot of U.S. multinational. That's good for U.S. profits here as well, for our companies in the U.S.
Yeah, indeed. So the importance, of course, of seeing China enact those policy measures, and certainly Europe is very exposed as well, of course, to what happens in China. Back in the U.S., though, or at least switching focus back to the U.S., Catherine, are you concerned there's been some warnings again about the complacency in these markets? U.S. Equities, of course, had a bit of a rough August, but last week was a pretty decent week for U.S. stocks. Are U.S. markets looking through some of the concerns, some of the risks, and is there complacency?
Complacency, I would say yes. When you take a look at the valuations on the market, yes. At about 20 times this year's forward earnings, yes, there seems to be a little bit of complacency. As you mentioned, we came off of a very tough August. People were concerned about Jackson Hole. They were concerned about China. But coming into September, we got some decent numbers from the JOLTS. We got a nice employment number, which was all good news, for the doves out there. But our expectation is about that these numbers are not going to be a smooth sailing going forward. You're going to see a lot of discrepancies where we have pockets of strength in the economy, pockets of weakness, whether or not the inflation numbers continue on that downward trend. So far, it's looking like that. But I will caution, in July and in August, we did see an uptick in energy prices. And now if China does come online with that strength, we're going to probably continue to see energy prices rise. However, with that, I think that there are some places in the market that you can really take a look at to either that have to catch up or to help ride you through those waves, because what we've come through has been an earnings recession, I believe. Okay, we do think that that consumer will probably hang in there. We're not going to see negative GDP numbers. But we had that in the earnings numbers in the past. But as those inflation numbers start to come down, they're going to start working themselves into the profit margins of companies and into better earnings into next year. But where the caution comes is that. Go ahead, John.
No, the warning on the earnings recession is really pertinent, of course. And so that leads me to the follow-up question, which is which parts of this equity market are most vulnerable to that earnings recession, and where are you finding resilience and companies able to maintain margins?
Right. Consumer is definitely one of those areas that we would be very cautious on. We would stick to sectors where there's opportunity for the profit margin expansion, like in what we would call staple technology that works within the overall ecosystem of the growth sectors, but you're not paying up for the stock prices. For example, like a Broadcom or an Oracle, where they're trading at 50% discounts to the overall sector, but you need the chips from Broadcom and you need the software support from Oracle to be able to create that AI ecosystem. And you're getting a dividend, and you're getting strong dividend increases. So cash flow is really important. It's going to be all about, valuation, cash flow, dividends, and quality.
So that is the rationale for being overweight staple tech. And a lot of those characteristics, Catherine, will be reflected and are reflected in the energy sector. We've been dissecting the moves higher in oil on the show today. Do you,
Right.
when you look at the energy sector, are you seeing some of the similar characteristics? Is that another area where you may want to lean into in the weeks and months ahead?
That's another area, yeah. It's another area that we are overweight in at this point in time. And given the fact that energy prices have increased in July and in August, we haven't really seen that reflected in the stock prices. Chevron's a great example of that. We're seeing inventories are starting to draw down. We haven't replaced the strategic reserves. China, if we can continue with the good news that we're hearing out of China, you're going to start to see energy prices continue to rise. I mean, they're already at a high for this year, but have not yet hit the highs that we've seen over the 52 weeks. So continued upside surprises in the price of oil will be good for these companies and stocks that have not participated in the overall market run that we've seen so far this year.
Okay, Catherine Avery, CEO and President of Catherine Avery Investment Management. Have a fantastic Labor Day and making the case there for how to position in a more volatile environment with a preference for energy and staple tech. We really appreciate your insights and taking some time out